exploring how we can master ourselves by looking at how experts say it is possible with your host, Shashwati. Welcome to Season 2, Episode 73 of How to Be with me, Shashwati, as your timid presenter, guiding you through life's tricky topics and skills by reading through the best books out there. Whether we realise it or not, money and finances play a key part in most of our lives. From receiving pocket money as a child to saving for a wedding or planning for a pension, financial behaviours are integral to growing up and growing old. Yet despite this, money management, investments and financial behaviours are often negatively perceived within society. People often feel stressed and anxious when faced with financial and investment terminology, and it's even more harrowing during a cost of living crisis. So how do we get clued up on finance? Here are Rachel Fox, Director of Business Development at Sunny Day Fund, and Karen Barrett, CEO and founder of online financial advice platform Unbiased, on their views.
Especially in the workplace, demand for financial literacy resources have skyrocketed. As boomers retire, the younger generations filling these positions are increasingly leaning more on their employer to address financial wellness and provide them with the tools to help bolster financial stability. The advantage to the employee is magnified if that worker can participate in a financial literacy program through their employer. Not only is access usually more affordable, but the convenience of payroll deduction allows for greater choice for employer-delivered solutions. Take, for example, the payroll-deducted emergency savings platform through Sunny Day Fund. This is a program which delivers financial literacy principles to employees, but because it includes a payroll-deducted vehicle, it sees a much greater adoption rate of behavioral change, rather than leaving the onus on the employee to implement these new financial strategies on their own through their banking institutions.
Financial literacy is crucial as it enables us to make life's big financial decisions with confidence, whether that means managing debt in the right way, living within our means, or putting enough money aside for our financial futures. While managing our money can sound easy, this often isn't the case. Due to the lack of financial education in schools, our first experience of how money really works typically occurs once we hit our late teens or early 20s. We're then bombarded with financial jargon such as pension, compound interest, negative equity on stocks and shares. It's no wonder we can get confused and either bury our heads in the sand or make harmful choices with our money. To make sure that we're doing the right things, it's important to speak to someone who knows what they're talking about. Financial advisors can help you make smart choices with your money. They cut through the jargon, helping to make the complex simple. Everyone's financial situation is different, and we all have our own unique goals. Financial advice can ensure we make decisions that are the best for us and our loved ones.
Our first book is from Simran Kaur, who is a financial columnist, international TEDx speaker, and founder of Girls That Invest, the #1 global podcast aimed at increasing financial literacy for women and minorities everywhere. Girls That Invest, Your Guide to Financial Independence Through Shares and Stocks, is her book on the subject. She was kind enough to speak to me, so here is a snippet, but find the full interview on www.howtobe247.com or on the YouTube channel.
When it comes to why we should be investing and why it's important, I think there's so many reasons, but the #1 reason that sticks to me the most is that investing is often the difference for us between having a life that we want, which is abundant and full of lots of choices, because when you have more money, you have more choices, versus having a life where maybe you're saving a lot and that's awesome and you're putting it into cash, but you're not getting the same results and you might be maybe making some sacrifices in life that you shouldn't have to. I think the stigma also comes from the fact that we're just kind of conditioned that way. Like if you think back to your childhood and you think back to your first memory, your first conversations with money, it's often with your parents, telling you off or asking about money or making you feel like it's very hush-hush, like, don't ask your auntie and uncle about, that financial situation that's very obvious. And so things like that just start to creep up. And I think there's no one big talk that you get that makes you fearful of money. It's just all these little things that start adding up. Oh my goodness, right? I mean, I just for the longest time used to think like when people said this company is raising capital, I was like, that's so impressive. They were just raising money. Like that was no different to a fundraiser. And yet here I was thinking that they were doing something so impressive. This is my theory when it comes to jargon. I think back in the day, jargon was used specifically to make you feel like, oh my goodness, this is like another language, and I would rather trust someone else to take care of my money because I do not have the time or the energy to understand what's going on. And when we talk about money and finances in our book or in our podcast, often people go, wow, like that is really simple. And I'm like, yes, every concept with investing and money is so simple, but the jargon just like fluffs it up a bit and makes it look like it's so much more harder than it is, but nothing is, outside of your reach of understanding. It comes from such a place of privilege to even be able to say, hey, there's an economic crisis. Can I even do anything about it? Do I have enough cash stored or can I start putting more away? But I think there's two things that we can do during these times just to, I guess, get us through the season. It is so difficult right now. Cost of living is extremely high. We're starting to see companies, especially in the tech sector, starting to have layoffs, which is very, very scary. And the first thing that I always talk about is the idea of making sure that you are irreplaceable in your jobs, because right now is a time where companies start to realize, well, people aren't spending because cost of living is so high. So now we're not making a lot of profits. And they start to look inwards and go, well, is there any, meat we could cut out? Is there any extra in this company that we don't really need right now? And maybe we still need them, but we can't afford them. And so, one thing that's important to do is look around and see what you can do within the brand that you're in. And I mean, this is more for people that work a 9 to 5 to kind of show that you've got your fingers in different departments and different areas, and you've got something that's so valuable that it makes sense for them to hold on to you. And that can look like having a conversation with your manager and going, hey, I'd love to upskill. What else do you need help with? I've got an extra hour a week, which not be a lot of your time, but for them might mean a lot. Or, hey, I've started watching some online courses to help in my job just so I can get better at what I'm doing. That's step one, making sure that you can have a job that sustains you through this time. And that's going to maybe one day hopefully increase your income too. And then number two, the second most important thing is having an emergency fund. And an emergency fund is about 3 months of your living expenses saved up just in a bank account. You don't have to invest it. You don't have to do anything fancy with it. And that's just in case, we do lose our jobs or our car breaks down or your laptop dies and you need something instantly. You have dental, work, and, we all know how expensive that can get. During normal times, it's important to have an emergency fund, but during economic crises, even just putting $10 aside every week into an account that you don't touch might be the difference between you having to let go of something quite important or being able to fund yourself for the next couple of months. Oh, that's a great question. I think it depends on who you're asking and what you want out of it. So, when it comes to the share market, for example, there are people that have very strong opinions on it. But to me, I just try to look at it as black and white as possible. And maybe that's the wrong way of looking at it. But the way I see it is there are companies out there, and when you put your $100 into a share of a company, you're hoping that if the company does well and other investors see value in it, that $100 share will turn into a $150 share after a couple of years, and you make some money off that. Now, there's also other ways of investing which are maybe you could say more slimy. And so we might recall with the hedge funds, Melvin Capital last year, or was it the year before now? I think time's just a blur. They were investing money on the basis that GameStop shares were dropping. So the more GameStop was doing poorly, the more this hedge fund was making money. And that's it. It's called shorting. And, that seems a little bit disingenuous almost, or you're making money off the demise of another company. And so I think there are definitely some examples that I don't agree with, but if you're looking at black and white investing in the share market for your long term, retirement, then I think it can benefit the everyday person.
One of the main reasons Cora decided to embark on her investment journey was because of the notion that women are supposedly bad with money. But the truth is that there are institutional and structural barriers, money media not representing women and people of colour, as well as a culture of shame around discussing money. Obviously, it's important to mention not everyone can invest. There are definite socio-economic factors that can be a huge barrier to people, so keep this in mind. Financial education has been scarce, and it has not been accessible. The jargon is full of heteronormative, classist, and guilt-inducing language. It's a concept women and minorities around the world are all too familiar with a number of studies showing only 16 to 20% of women invest, and with women only having 44 cents for every dollar of men's wealth, according to the US 2019 survey of consumer finances conducted by the Federal Reserve Board. We're lagging behind when it comes to financial wellness and growth. We've all heard of the wage gap, where women who are in the same field with the same experience are making less than their male colleagues, but with very little attention given to the wealth gap. When we aren't making enough money and aren't investing enough, we see a much larger, much more damaging financial gap, with cis white men on one side and quite frankly everyone else on the other. Women around the world weren't able to even do the most basic financial planning for most of modern history. During the 1700s, in the US and UK, British common law allowed for husbands to have complete control of any property a woman brought into the marriage. Progress was slow. In 1771, women were allowed to have a voice on how husbands managed their joint assets. How generous. It's also important to acknowledge that in the US, these laws only applied to women of European descent. Not all women. African American women were still without basic human rights during this time and were completely kept out of the financial sphere. It wasn't until 1900, only 120 years ago, when women in every state in the US were able to control property. In Australia and New Zealand, it was 1884. In the UK, it wasn't until 1922. And in India, 1956. That's only 1 to 3 generations ago, where the women in our families could control their own property. Women have missed out on thousands of years of financial discourse. Next, money media speaks to men about growing their wealth and portray it as a masculine trait. Articles directed at men talk about investing strategies or encourage debates about the latest cryptocurrency, while articles directed at women tell us about a new hack to save $10 a week on groceries. And it's not just anecdotal. A 2018 analysis by Starling Bank in the UK scanned over 300 finance articles and showed 70% of money media directed at men discussed investing, while 65% of money media directed at women were about spending less. Then there is the taboo of speaking about money. By keeping silent about money, we only make it harder for women and minorities to get paid more, to negotiate better, to learn how to invest. And by keeping money as a secret topic, we only make it harder for more people to understand how wealth creation works. Who's benefiting from our silence? Not us. Kaur first addresses why you should become an investor in training. For one, she says you can help beat inflation. In simple terms, inflation is where the price of goods and services slowly creep up year by year. It isn't a good thing. You don't notice the effects of inflation every single year, but you notice it when you get flashbacks about how those £4 ice creams only cost 99p in your childhood. The problem with inflation is less to do with goods and services slowly becoming more costly, and more to do with the fact that the value of your money decreases annually. As time goes on, your money is worth less and less. $100 in 2000 has a buying power of $58.72 in 2022 due to inflation chipping away at it year by year. Next, it helps you to take advantage of compounding interest. So how does it work? Imagine that you have invested $1,000. This is your principal or initial amount of money invested. We're working with dollars here for now. And you get 10% interest on your money that year, giving you an extra $100. Great. You now have $1,100. This is your new balance. Next year, you also have another 10% interest. But this time, it doesn't just work on your original $1,000. It now also works on your extra $100. So your money grows to $1,210. You begin to get interest on top of your interest, which means you get to experience exponential growth. It also helps you to reach your monetary goals faster. Compared to any other way of seeing your money grow, investing allows you to earn a greater return. The time it would take you to make $1 million if you saved $600 a month is 138 years. The time it would take you to make $1 million by investing $600 a month, assuming a rate of return of 8%, is 32 years. People are shaving off more than 100 years by investing over saving, apparently. She says the average millionaire has over 7 streams of income, and investing has always been one of them. Getting financial freedom and security is hugely important for many. It is a massive source of stress for women. In fact, a 2019 survey by Salary Finance showed millennial women were more stressed about money than millennial men, and were more likely to suffer from panic attacks over financial issues. Finally, Kaur says it may help to create a better world through ethical investing, which is investing only in ways that align with your values and morals. You get to support companies that place an emphasis on environmental, social, and governance factors. In 2015, only $5 billion was invested into environmentally sustainable funds in the US, but by 2020 that had increased to over $51 billion, and it's only growing stronger. Hence, actionable steps include, first of all, research the inflation rate in your country this year. The value of your cash has gone down by this percentage. Make sure your pay rise this year is in line or above inflation. With a pen and paper, write down what you want your life to look like in 5 years and 10 years' time. How much money would you need to achieve that goal? Then finish this sentence. Investing for financial security is important to me because ... Then write down 3 causes you're passionate about. Research if there are any companies that align with your views and how their stock prices have been performing. She then goes through common misconceptions about investing. The first being you'll lose all your money investing in the stock market. There are strategies, methods, and hundreds of years of research that direct an investor's decision-making. You need to check out an investment's risk through some research. It's also worth noting the bounce back after every recession. The next myth is that investing is like gambling. Investing and gambling both involve risk, but that's where their similarities end. Gambling is a short-lived activity that involves chance, while investing involves choice. Investors are able to decide on their risk profile and invest in companies and funds that align with that profile. It's important to be careful of speculative bubbles where shares are bought at an inflated price due to hype. Soon after, they crash, such as that of Tesla stock, which 12% in 2021 after a massive boom. Investing is seen as complicated, from the jargon to the numbers. Luckily for us, times have changed, and the calculations needed for investing are becoming easier and easier to find online. Investing education websites such as Yahoo Finance provide investors with resources so they no longer need to whip out their old graphing calculator to work out the numbers. But before we begin investing, there are 5 personal finance concepts to tackle. To lay your financial foundations, you should, number 1, know what's coming in and out. 2, tackle high interest debt. 3, make sure you automate your money. 4, make a rainy day fund. And 5, sort out your retirement account. Actionable steps include, first, track your spending for a week. Then, find out what debt you have. Then, you will need to work out how much you can put away every week or month to invest. Make a separate online account for your emergency fund as well. Research your country's top 5 retirement accounts and see what options are available for you. Find out what retirement scheme you have and what fund type you have. Does it match your goals? Then contribute to your retirement scheme, the maximum amount your employer will match. So it's time to break down some of the jargon. If someone wants to raise more money for their business, such as a cupcake stand, They could break their company into pieces or shares. These shares are then sold to investors on what is the stock market. This process is called an IPO, or initial public offering. It's basically when companies get to shout from the rooftop that they're going from a private company to a public one. If you keep 600 of the 1,000 pieces, then you are a majority shareholder. But if any of those pieces are sold on to a third party, you don't profit, only the seller does. The stock market is just a facilitator that allows people to buy and sell shares amongst each other. It's like eBay, where on one side there is someone trying to purchase the product, and on the other side is the seller trying to sell the product. Only in the stock market, the product is shares. It really is that simple. A stock exchange is a location where stocks or shares are exchanged, i.e. bought and sold. There are many stock exchanges around the world, many in the most prominent cities of large countries. In fact, there are 60 exchanges worldwide. Out of these, 16 of them are extremely large, with the value of the companies listed on each of these large exchanges being over $1 trillion. Think of a stock exchange like a list. Most countries have just one list. It lists all the companies that you can buy stocks in. This lets you see how much the price of that company stock is and how much that price has changed since yesterday. The US stock market is made up of 13 US exchanges, such as their famous New York Stock Exchange or the NASDAQ exchange. There are many different ways to invest your money, but I'm going to break down the most popular ones you'll come across. There are stocks and shares. Stocks can be thought of as the purest form of investing, choosing a company and putting your money on the line to back them. There's bonds. Bonds are much less risky than stocks. With bonds, the company or government are basically asking you to loan them the money. They'll pay it back to you with a fixed amount of interest to say thank you for letting them borrow it. Mutual funds. Mutual funds are baskets that can be filled with many different combinations of stocks, bonds, cash or cash equivalents and other investments. Index funds. An index fund is a type of mutual fund. The three most common indexes are the S&P 500, the Dow Jones Industrial Average, which follows the top 30 companies in the US, and NASDAQ, which follows the top 1,000 tech companies in the US. ETFs are exchange-traded funds, which are like the shadows to index funds. The difference is that it has a lower barrier to entry and you can buy and sell throughout the day, not just when the market has closed. REITs, which is Real Estate Investment Trusts. These are the funds of the real estate world. Rather than investing in a basket of companies, you now get to invest in a basket of real estate. There's also hedge funds, which are just like mutual funds, but basically on steroids. Commodities and alternative investments are types of investments that help provide more diversification, and they help to hedge against inflation. So how do you make money on the stock market? Through capital gains and dividends. Capital gain is when you buy an Apple share for $150, for example, and sold it at $160. You've made $10 in capital gains. Whilst dividends is basically how a company says thank you for holding their stocks in your portfolio. They pay you a small percent of their profits, usually every quarter. An extreme form of investing is starting to gain traction around the world. It's called financial independence, retire early, or FIRE. A concept coined in the 1992 bestseller Your Money or Your Life by Vicky Robin and revitalized by Peter Adeni with his Mr. Money Moustache blog in the early 2000s. It's enabling people to retire earlier, in the 30s and 40s rather than at the traditional age of 65. The FIRE movement is built off the idea that you can build up an investing portfolio large enough that it acts like an unlimited little pot of gold. It's like being a trust fund baby, but rather than being gifted a trust fund by your Upper East Side parents, you created it yourself. You do this by increasing your income, for example, upskilling in a job, living frugally and investing the difference, as much as you can, into a broad market index fund. People who follow the FIRE movement try to save as much as 60 to 70% of their income. The more you can save, the better. There are macro and micro factors, such as tax and regulations, that can cause a market to act the way it does. The most important to consider are these four macro factors. Number 1, economic growth. Number 2, unemployment. Number 3, inflation. Number 4, high interest rates. Core recommends researching a company whose stock just dropped. See if you can find what caused the drop. For example, bad earning report, poor future prospect, loss of investor confidence, etc. Research the economic growth, unemployment rate, inflation and interest rates, i.e. the macro factors, in your local economy. Determine the timeline of how long you would want to invest for. She addresses different kinds of investors. The first kind is ethical investing, which means investing in companies and funds based on your own values and morals. In the stock market, the average female investor makes more gains than men. They also lose less money than men. A 2021 Fidelity study analysed over 5 million investors and found that the women made 0.4% better returns than the men. The lazy investor, or three-fund portfolio, is an investing strategy coined by John Bogle, the guy who invented index funds. Index funds, or ETFs, remember, are the baskets that invest into a list like the S&P 500 or the FTSE 100, are an integral part of the lazy investor strategy. It works by holding a total of 3 ETFs. Lazy investors don't fiddle around with their investment on a regular basis. Spicy investing is the opposite. People who day trade and prefer riskier investments like cryptocurrency. So the way to start investing is, step 1, unlearn those money mindsets that make you nervous about finances. Step 2, lay down those financial foundations and figure out what's coming in and out. Step 3, work out your investing goals. Step 4, work out your risk profile. What are you willing to lose and when you need your money? Step 5, work out your asset allocation, which is deciding how much money you want to put towards different investments. Step 6, choose where to invest, whether via a broker or an online platform like Nutmeg. Step 7, buy your shares. Kaur says, investing can and should be for everyone, but especially for those of us who have been left out of the conversation for too long. Our next book is by award-winning financial journalist Helene Orlin and University of Chicago professor Harold Pollack with the index card, Why Personal Finance Doesn't Have to Be Complicated. Here is Orlin on the David Pakman Show.
Well, the index card approach basically says that the financial industry, basically is part of their sales pitch is that this is a really complicated world and we can help you narrate your, guide you through it, right? But in fact, it's actually, as you said, fairly simple. And so the index card basically breaks it down into 10 steps. And in those 10 steps, we show that, the ideal is to save between 10 and 20% of your income to pay down your credit card debt, make sure you have an emergency savings fund. And then we talk a bit about investment. And so, for example, we say, don't buy individual stocks, find a low fee index fund, and basically get on with your life. This is not complicated stuff. You don't need to be overthinking it.
They start off with saying, saving money today is hard, but a few tips can help. The median annual household income in America dropped by $3,000 between 1998 and 2013 as wages decreased or stagnated. At the same time, the cost of living has gone up. This perfect storm of plummeting wages and rising costs has resulted in some frightening statistics. A whopping 27% of US households have a net worth of just $5,000 or less, and 47% of Americans say they couldn't come up with $400 in an emergency without borrowing money or selling something. Since so many people are struggling to get their financial houses in order, if you don't have any savings, you shouldn't feel bad. But you should take action. If you fail to come up with a saving plan soon, you will never be able to invest for the future or even pay off your debt. Think of it this way. If you save just 10% of your income every month, by the end of the first year, you'll already have a whole month's salary put away. Some tips include using cash instead of plastic. This may sound silly, but lots of studies have shown that people spend over 20% more when paying with a credit card or online than they do when they pay with physical money. Spending bills and coins is less abstract, so it's harder for people to part with them. You can also set up an automatic savings account. These automatically deduct and save a portion of your paycheck every month, which means you don't have to endure the temptation of spending it. Lots of employers can even reroute some of your salary towards a savings account for you. And credit cards are a recipe for financial doom. That's because this rapid transition towards easily accessible, high-interest credit means that the average American household bears a shocking $7,000 in credit card debt. In the 1970s, the credit card companies realized how much money they could make from people racking up massive debts and never paying them back in full. The profits of these companies now reap are a result of massive interest rates that are paid monthly by consumers who never manage to pay off their principal on their debt. That's why you should always pay your full credit card bill, not just the interest. Unfortunately, only about 1/3 of credit card holders take this route. Psychologists think it's because of a concept known as anchoring. People see the minimum required payment prominently displayed on the statement and anchor their thoughts about how much to pay based on that minimum. If you fall into this category, or if you simply can't pay off all your bills right away, just adopt this simple strategy. First, work out the annual percentage rate, or APR, of each debt. This number refers to the interest that's charged on a debt over the course of a year. It's important because the fastest way to get out of debt is to pay off the debts with the highest interest rates first. So make a list, ranking all your debts by APR, highest to lowest. From there, prioritize those with the highest interest while making minimum payments on the others. Once you pay off your first debt, just move down the list until they're all gone. For those who are fortunate enough to afford to buy a place, the authors say shop around for your mortgage to save thousands. They recommend only buy a house or a flat if you can put down 20% of the purchase price. This is important because the bigger your initial deposit, the lower your monthly mortgage payments will be. You'll have borrowed less money and therefore have less to pay off. In this way, a higher deposit can save you thousands of dollars over the lifetime of your loan. It may even result in a lower interest rate as well. That's because lower loans are less risky for lenders and they aren't compelled to charge as much interest. Beyond that, the bigger your deposit gets, the less likely your house's market value is to drop below what you owe on the mortgage. This is a real threat if the housing market crashes and you need to sell your property urgently. After all, in such a case, you likely wouldn't have time for the housing market to recuperate, and it's important to shop around because a small increment in the interest rates can end up costing you thousands extra. It's also important to start saving for your retirement today and make the most of your options. The fact is, just 20% of people work past age 65. You never know when health difficulties, age discrimination, or a crisis in the family might take matters out of your control. Another common belief is that people have decades to save for retirement and there's no rush. But compound interest complicates this assessment. For instance, if you save just £104 a month starting at age 25 and put it in a pension fund that yields 6% annual return, by 65 you'll have saved £200,000. However, if you wait until age 45 to start investing in the same fund, you'll need to deposit £430 a month to save the same amount by retirement age. So how much do you really need to save? Experts estimate that you should put away 15% of your monthly gross pay to ensure a comfortable retirement. That sounds like a lot, but your employer could be your key to success. That's because lots of employers offer an employer match for retirement savings. In such plans, an employer will match your pension contributions, usually up to 6% of your annual earnings in the US and around 5% in the UK per month. So make the maximum contribution you can to reap all of the benefits. Next is insurance, even though it's depressing to think about. Protect your family and finances by planning for the worst. A life insurance policy pays out when the insured individual passes away, but not all life insurance is equal. The best protection you can get at the lowest cost comes in the form of term insurance. This is a type of life insurance policy that's limited to a set amount of time. In the author's recommendation, a 30-year period. During that time, the policyholder makes an annual payment to keep herself covered, and the policy can be cancelled on a yearly basis. If you don't want it anymore, you just stop making your payments and your coverage goes away. But most importantly, shopping for term life insurance, get a policy that has stable annual payments throughout its life. Home insurance is equally important for those everyday events and accidents. So to sum up, Kaur says in Girls That Invest to unlearn those bad money mindsets, lay down your foundations, work out your investing goals, work out your risk profile, work out your asset allocation, i.e. decide how much you want to spend, choose where to invest, and then buy your shares. The jargon is much more simpler than you think. Olin and Pollack say in the index card that personal financial planning is the difference between a sound future and a deferred retirement. But the good news is that a few simple rules can de-stress your relationship to money and get your financial life in order. By planning early and often, you can get out of debt and ensure yourself a comfortable retirement. I've always had trouble thinking about money. It makes me nervous, and most of the conversations growing up was about what a struggle it was to stay afloat, especially in a single-parent household living in a housing association home. As a result, it's left me with a scarcity mentality that there is never enough, but it doesn't always have to be that way. Please join in on the conversation by following at howtobe247 on Instagram, Twitter, and Facebook, and subscribe on the podcast, which can be found via www.howtobe247.com. And there's bonus material that you can't miss at patreon.com/howtobe247. Just one more thing. Please do leave a review if you found this helpful. Before we go, here is Layla Johnson, a regional manager at CreditFix, and Matilda, a money-saving expert and the person behind the Instagram account A Millennial Saver, on their views. See you in 2 weeks' time.
One of the questions that people ask me recently is, why is it so hard to deal with your finances? I think in this day and age, it's a little less harder than what it used to be. A lot of people sometimes feel embarrassed talking about finances. They feel shame, which they shouldn't. I think sometimes people can get overwhelmed by it all as well, and it can be a daunting experience. I think for me, one of the biggest things how to deal with finances or anybody that is struggling with debt is to identify the problem first. Try not to bury the problem and try not to shy away from opening any letters. I think once you get to the root cause of the issue, then seek help. Seek help straight away. Seek professional help that can go through your situation and have a lot of solutions there tailored to your needs as well. One of the greatest things as well, if you are struggling with finances, is to create a budget and try and work in that budget, especially around food shopping.
The way we deal with our finances can often be how we perceive money growing up, especially our parents' behaviours. For example, if a parent was often in debt, you may be more conscious of this as an adult, or you may see it as normal because it's what you've known for a number of years. If you want to make your finances easier to understand and cope with, I'd recommend sitting down and understanding your own finances. What's your monthly salary, your outgoings each month? What are your fixed expenses, such as subscriptions or mortgage or rental repayments? And what do you spend on groceries? And write all of this down so that you can understand everything coming in and out of your account for the month, and look at where you can make small differences to increase the amount you may be able to save. For example, do you often pop into Tesco a number of times a week for food and you don't meal plan? Or could you do a bigger food shop at somewhere like Aldi and meal plan every Sunday for the week ahead? Or do you go out with friends for a drink a few times a week, and if you cut down you could save a certain amount? Budgeting shouldn't be completely restrictive, but it should enable you to understand where your money goes and your behaviours so that you can make small but smart decisions.